Hello everyone and welcome to Financial Accounting. Today we will learn how to determine the amount of interest due at maturity on notes receivable. I will also post a video in which I will show you how to use Excel to calculate interest and how to format Excel tables properly. I will post the link to the video as soon as I have it available. Please note that we will be using a simple interest today. I will post a separate video on compound interest calculation. Simple interest is a calculation of interest that doesn't take into account the effect of compounding. In other words, previously earned interest is not added to the principal when interest is calculated. The amount of interest due at maturity is equal to the face amount of the note multiplied by the annual interest rate and multiplied by the term of the note divided by 360 days, the approximate number of days in a year. 360 days is used for convenience. Some textbooks use 365 days when interest is calculated. We will look at 5 examples of notes receivable to determine the amount of interest. All notes start on different dates and have different face amounts, interest rate, and terms. In situation A, a 60-day note of $60,000 was issued on January 6 at 8%. The term of a note is the amount of time between the issuance and due date. Now, let's calculate the amount of interest due at maturity. It is paid on the note face amount for the length of the term of the note. The interest on a note is calculated as a product of the face amount, the interest rate, and the note's term. In this case, we multiply $60,000 by 8%. Then, multiply the resulting amount by the fraction of 60 days, the term of the note, divided by 360 days, or the approximate days in a year. The result is an amount of interest due at maturity of $800. In situation B, a 90-day note of $10,000 was issued on February 15th at 12%. To calculate the interest due on the maturity date, multiply $10,000 face by 12% and then multiply by a fraction of the 90 days term divided by 360 days in a year. From this calculation, we determine the interest amount due at maturity to be $300. In situation C, a 120-day note of $15,000 was issued on June 30th at 14%. Using the same procedure I previously explained, multiply $15,000 by 14% and then multiply the resulting amount by the fraction of 120 days divided by 360 days. The result is interest due at maturity of $700. In situation D, multiply the product of $25,500 and 8% by the fraction of 30 days divided by 360 days. The interest on the note at maturity is $170. In a similar manner, for situation E, we complete the interest calculation on the note by taking the product of the face amount of $9,500, the interest rate of 6%, and the fraction of 45 days divided by 360 days to arrive at interest amount at maturity of $71.25. Of course, we don't want to calculate interest manually. It is much easier and faster to do it in Excel. I will show you how to do it in the next video. Here is a preview. The interest amounts are calculated for each note. You can find more videos about financial assets in the playlist for Chapter 7. The link is posted here and in the description box. I hope you found this video helpful. If you did, please make sure to subscribe, hit that like button and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.